Morning, Kathy.
So you expected 3% for May inflation. It turned out higher than forecast. What do you make of the actual result?
It's higher than what we were expecting. It's higher than the consensus. I think the street was expecting 2.9%. At the end of the day, though, it still falls within the central bank expectation, expected range of, I think, 2.8 to 3.6%. So it's still within that range. I think, it doesn't change our forecasts at this point. We still believe there could be, in terms of monetary policy, we still believe there could be one more rate cut this year and possibly a 100 basis point increase in the reserve requirement. That said, I think
Julian, you
what
even
this still
ventured
means,
to say
yes,
earlier, I mean, before the inflation result came out, that there is a chance that inflation would fall below 3%, even lower than the consensus of 2.9%. What do you think you missed?
Well, we were expecting the drop in fuel prices and the drop in rice prices to possibly be the source of a better than expected inflation print. However, as from the speech earlier, it seems like food prices in general, housing and restaurants pulled the number up and overwhelmed those two factors I mentioned. I think those two factors would still be more pronounced over the course of the year, and so we think
so if that's going to be the case, Julian,
yeah.
Following today's result, will you be reviewing any of your estimates from here on out?
Yes, we'll be reviewing our numbers, but we're keeping those numbers unchanged at this point.
And what about the rate cutting and the RRR cuts? Do you think that might change towards the end of the year?
We think if you get a rate cut soon, that could actually open the door for another rate cut at the end of the year. But as we speak, we still think there's just one rate cut for the course of 2019 and possibly another reserve requirement cut over the course of the year. What this implies, Kathy, for us, it's still within the range, and it still affirms the ability of the central bank to continue accommodative monetary policy. Accommodative meaning, for us, meaning make lower rates, making money easier or cheaper for business to grow. And we think at the end of the day, this further helps to perpetuate the Philippine economic growth story, which is still intact, alongside healthy consumption levels, improving consumption levels, alongside what we think is an underappreciated fact that we are on the cusp of a massive 9 billion peso infrastructure government spending program that will create jobs, improve lending, boost property prices, and the whole multiply and boost consumption at the end. And it's a whole multiplier effect. And we think this is important because at the end of the day, this certainty as to where the growth, this clarity as to where the growth drivers of the economy will come from over the medium to long term, makes us a relatively safer haven investment option for foreign investors.
But what is it going to mean for the Philippine peso?
Global uncertainties mount. Sorry?
What will it mean for the Philippine peso with the rate cutting?
Probably more stability in the peso. If rates stay or are reduced marginally, could mean some stability in the dollar peso rate. We don't expect a major move, although at the end of the year we're still looking at about 54 peso dollar peso exchange rate level.
Final point, Julian, your fund is up over 14% versus the benchmark PSE index, the best performing year to date so far this year. And for the past 3 years, how are you recommending clients position for the second half, given the assumptions you've just given and the policy rate cuts and the RRR cuts?
Invest in growth. Philippines, as I mentioned earlier, is a safe haven because of clarity of where the economic growth drivers will come from. That's consumption, infrastructure, and accommodative monetary policy. So companies, invest in the companies that will benefit most from an improving economic growth story for the Philippines.
All right. Well, thank you so much for joining us. And for those immediate views there, Julian Tarrobago of ATR Asset Management in Makati.